Hello everyone. In this video, we will have a look on the presentation of the ratios, their formulas, and what are the certain points that are needed to be kept in mind. After this video, I am damn sure that all the confusions regarding the ratios presentation will be clear if you watch the video till the end. So let us start our video. So before going deep into the ratios and its component, let us have a look on certain points that are very essential and are to be kept in mind before presenting those ratios. So, the first and foremost requirement of the Schedule 3 is that the company has to disclose only these 11 ratios, and the company cannot go on presenting any other ratios. The company has to present the ratio for the current year as well as for the previous year. Well, as then a ratio is nothing but a division of numerator by denominator. So the company has to explain the component of the ratio in the financial statement to make it more understandable to the stakeholders of the company. Otherwise, the stakeholder will never know that what are the numerator and denominator the company has used for computing the ratios. Then one more thing, the Schedule 3 is requiring the company to present, that is the reason for explanation of the variance in the ratios when compared with the previous year if the change is more than 25%. And that is a very good point. From these, the stakeholder will get to know why this ratio has changed. For example, if the current ratio has improved by say 30% or 40%, then the company will have to disclose the reason of why the ratio has improved. It may be because of the closing inventory has gone high, or because of the company has paid the debt, or the current liability is outstanding at the end of the year. Now, there is always a confusion whether the ratios are to be presented in standalone financial statement or in consolidated financial statement. So, as per the guidance note of ICA on the revised Schedule 3, ratios are not relevant for the consolidated financial statement. It is only to be reported in standalone financial statement. One small disclaimer I would like to give that the ratios are fixed, but its component may vary depending upon the judgment of the auditor or the management. I have gone through with guidance note and certain listed companies' financial statements, and I prepared accordingly to that. It is quite certain that these ratios components may change depending on the judgment. So it is not there that you have to stick to the ratios, but if these are considered, I think there will not be any issue. So let us start our discussion with have a look on the 11 ratios that are to be presented. So these are the ratios which are to be presented: the current ratio, debt equity ratio, net profit ratio, return on equity, inventory turnover ratio, trade receivable turnover ratio, net capital turnover ratio, debt service coverage ratio, return on equity capital, return on equity employed, return on investment, trade payable turnover ratio. So one more catch is there that the ratio number 5, 6, 7, 8 are to be presented in the percentage form and rest in the number form. For example, current ratio, current asset by current liabilities. The ratio will be in the number form, that is 1.2 or exactly 2 or 2.5. But in case of net profit ratio, that is profit by revenue, will be in the percentage form, that is 80%, 20%, 25%. Now let us go deep, starting with the current ratio. Current ratio, it is a very common ratio which is calculated by dividing the current asset by current liability. Both the figures will be taken from the financial statement. Current ratio basically depicts the position, the financial position of the company to repay its current liability that are to be due in next 12 months. So current asset and current liability can easily be taken from the face of the financial statement where we disclose current asset and current liabilities. One catch is there are certain assets which should be excluded from the current assets. The reason is those assets may not be forming part of the working capital, like current maturity of long term investment. Say, for example, if the company is having quite a good investment portfolio, but the company is in FMCG industry. So there may be cases where the company have current maturity of long-term investment in the current assets. So the company should ignore these investments for the purpose of calculation of current ratio, as these current maturity of long-term investments will not form part of working capital requirement. That is a logical reason. Otherwise, otherwise you can simply take current asset by current liabilities from the balance sheet, but the correct picture should be presented considering the judgment of the auditor. Next ratio is debt equity ratio. So debt equity ratio is nothing but total debt by shareholders equity. It depicts the number of times the company is having debt over its equity. It depicts the obligation of the company in comparison to its own equity. So in many cases, we have noted that total debt only include the borrowing, but this is not good, because as per India's 116, there is a lease liabilities also in the financial statement. So the total debt must include all the borrowings, current and non-current, lease liability, current and non-current, and interest accrued on such borrowings will form part of total debt. And shareholders' equity basically means those which are accruing to the shareholders of the company, that is equity share capital and other equity. And both the numbers can be taken from the financial statements, from the balance sheet. Next ratio is debt service coverage ratio, which depicts the capability of the company to service its debt obligations, that is long-term debt. Debt service coverage ratio is calculated by dividing the earning for debt service by debt service. So earning for debt service will include profit after tax plus non-cash expense like depreciation and amortization plus finance cost plus non-cash operating expense like loss on sale of asset, loss on fair value of investment, CSR expenditure if not paid. And these numbers will be extracted from the profit and loss account. Then the denominator, debt service, will include finance cost, payment of lease liabilities, plus principal repayment of long-term borrowing, and which will be from cash flow statement. Next ratio is return on equity ratio. It is a very simple ratio which shows how much the company is earning over its share capital. It is calculated by dividing profit after tax by average shareholders' equity. Profit after tax means the profit for the year from the profit and loss account. And average shareholders' equity will means average of total equity, that is share capital plus other equity of current year and previous year from the balance sheet. Next ratio is inventory turnover ratio, which depicts the number of times the company is churning its inventory, that is company is converting its raw material, packing material, WIP into finished goods. It is calculated by dividing the cost of goods sold by average inventory. So cost of goods sold means all the direct expenses incurred in generating the revenue, that is cost of material consumed, purchase of traded goods plus changes in inventory plus consumption of stores from the profit and loss account. And average inventory include average of inventories of current year and previous year, which will be extracted from the balance sheet. Next comes trade receivable turnover ratio, which shows The number of times the company is churning its debtors means number of times the company is converting the debtor into cash. The more the ratio, the more is better. It is calculated by dividing the net credit sale by average debtors. Net credit sales means revenue from operation minus cash sales, if any, from the profit and loss account. Average debtors means basically average of trade receivables of current year and previous year, which will be extracted from the balance sheet. Next comes the trade payable turnover ratio. So it is also like trade receivable turnover ratio, but it is related to purchase only. It depicts how much or how many times the company is converting its trade payable into cash, means how many times the company is paying the trade payable over a period. If the ratio is more, obviously the current ratio will be good for the company. Now it is calculated by dividing the net credit purchase by average trade payables. So net credit purchase will obviously include purchase of raw material, packing material, traded goods, purchase of stores and spares, but it should only be credit purchase, not cash purchase, which will be derived from the profit and loss account. And average trade payables means the average of trade payable of current year and previous year, which will be from the balance sheet. So you see, in case of net credit purchase, every item other than stores and purchase can be directly extracted from the profit and loss account. But in case of stores and spares purchase, you have to use the following formula. That is the consumption of stores, then add closing stock of stores and deduct opening stock of stores. And then you will get the purchase of stores. Next is working capital turnover ratio, which depicts how efficiently the company is churning its working capital. It is calculated by dividing the revenue by working capital. Revenue means revenue from operation from the profit and loss account. And working capital here means current asset minus current liability. Please remember that current asset minus current liability will be the same that has been used for calculating the current ratio. Next ratio is net profit ratio, quite an easy ratio, which shows that how much the company is earning from its total revenue. It is calculated by dividing the net profit by total revenue, which will be from the profit and loss account. Next ratio is return on capital employed ratio, which means that how much the company is earning on all the capital employed. Not only the share capital, but includes also the debt obligations. So the formula is earning before interest and taxes divided by capital employed. Earning before interest and taxes includes profit before tax plus finance cost. But capital employed, it is quite a lengthy formula. The formula includes total equity plus total borrowing plus total lease liability plus interest accrued on borrowing less intangible assets, less intangible asset under development, less deferred tax assets. So the logic of deducting the intangible assets and intangible asset under development is we are calculating tangible net worth, and tangible net worth basically means total net worth minus intangible assets. We are adding total borrowing and lease liability because these are the debt obligations which will form part of the capital of the company, basically the external capital, but it is quite in capital. And we are deducting the deferred tax asset also because deferred tax asset is a fictitious assets which have increased my net worth. So we have deducted the fictitious assets, deferred tax asset from this formula. Last ratio is return on investment ratio. So return on investment ratio is quite simple, that you divide the income from investment by the average investment over the period. Income from investment will include all form of investment income. It will not only include profit and loss on sale of investment, but it will also include interest income on investment, like interest income on AIF, interest income on debenture, interest income on perpetual bonds, plus